like to introduce our speaker today. Jim and I have known each other for forever. I'm really pleased and lucky to have him here to speak with us. He's the founding manager, director of Tech Council Venture. We'll tell you all about it. And usually the first guest speaker has the toughest job, because he's going to come in here and tell you all about the stuff he does, and you haven't even had a chance to start the course. So you're going to hear a lot of terminology, you're going to hear a lot of vocabulary that may throw you off. Just stay with it. We will go through that, and you'll get to understand everything as the semester goes on. But what I do with all my speakers is that I ask you to write down 3 questions, so you can ask the speaker, because I think they love to be asked questions. Now, if you read the syllabus, the last thing I'm going to say, if you read the syllabus, you know that I've asked that you keep your laptop off when we have a guest speaker. When I speak, you can open it up, you do whatever you want on your laptop. But as just a respect to our guest speakers, please have your laptops off and try to write those 3 questions if you can on your phone, or if you want to open it up for a second to write those questions, that's fine too. That's all. So with that, I'd like to introduce Jim Gunton.
I'm actually going to be, and I'm not trying to do this to put people on the spot, but just to try and create a more engaged environment, because there's no way I'm going to be able to speak for an hour plus here just by myself. So I'm going to just randomly call people. And to Shahram's point, I do realize, and I think everybody here should realize, that coming into the class, there'll be some people that have familiarity with the venture capital, and some people that know about entrepreneurialism, and some that don't. So again, just FYI, I'm not trying to make people anything other than trying to move the process along. Just one quick comment, which is that to Shahram's point about laptops, in 1992, so I spent the first 10 years of my career in Silicon Valley. I was working at a company called Oracle, which is a big database software company. So when I went back and I got a graduate degree in business, I naturally brought a laptop with me because it was more effective and more efficient. And I was the only person in my class, like 300 people, to have a laptop. And so people were like, you want to lose that laptop, you're looking like, you kind of look like a chump, number one. And number two, I'd be like taking exams and clicking, and people would be like, can you keep that down? So the world's changed since then. Anyway, so so the agenda. So our agenda this afternoon. So Shahram encouraged me to talk in stories, so I am going to do that. I trust people at least saw and hopefully read some of the material in advance. Can we? Yeah, hopefully, yes. So the first story is kind of how I got into the venture industry, and you guys are all young. I will tell you that your career path is going to go in ways that you really can't control. I mean, to some extent. And by the way, so yeah, I think in listening to the what Shahram is going to talk about for the next part of this semester, it sounds great. I mean, what an opportunity. When I was in college, I had no idea what venture capital was. So this is really a wonderful opportunity for each of you. So the agenda, we'll talk about 3 stories. So one is how, in my situation, how I came to get into the venture industry. And then number 2 and 3 is a couple of case studies, a couple of real life investments, and we'll try and figure out what the good, what the bad, and would you ultimately decide whether or not you wanted to invest. So that's the agenda. and along the way, we'll talk about the market, because this is a market, and I think Shahram and I have both been doing this for a long time, but this is a market with its own characteristics, and we'll talk about what those are. And then we'll go through a return model. which is, in some cases, for some investors, the core of what guides your thought process. Questions or comments or anything else that maybe, again, I do realize this is the first time that you're hearing, you have 10 speakers, so, but anything else that be helpful to talk about or think about before we launch into this? Okay, so I haven't forgotten, by the way, I'm going to start calling on people, but it's just going to take a little bit of time. We have to first get into some of the real content. And you can all hear me right in the back row? Everything good? Okay, because I'm making jokes and nobody's laughing, so I'm just trying to understand why that's happening. So May 1994. So I graduated from college in 1988. Went back and I got a degree in business in 1992, and I graduated with an MBA in 1994. So in both of those situations, coming out of college and coming out of graduate school, no job. So I do realize that increasingly, right, for even high school, but certainly for college students, it's important to get an internship. And by the way, it stinks. The whole process of trying to find, right? I guess Shahram's looking at his. But the whole process of trying to find professional opportunity, it's hard. So just know that in advance. It's just hard. It's inefficient. But with inefficiency lies opportunity, and that's kind of the core of what entrepreneurialism is about. So I mentioned I worked at Oracle. I also, coming out of graduate school, had spent a summer with an investment bank in Seattle. And I had sent out, when I was the second year, which is your last year in business school, I sent out about 100 resumes. And this is all just as context to describe, my story of how I got to be in the industry, into the venture industry. So there's a local fund called Edison Venture Fund. They were one of the 100 firms that I had sent a resume to in 1994. And so they were one of the, whatever it was, 4 or 5 groups that had responded to my outreach. And they called me in for an interview, one of their associates. And I think I probably even came up from North Carolina. I was at Duke getting my MBA. So I drove up, had the interview, went poorly. And I thought, in my head, I'm thinking, oh, well, that's done. One of those 5 is gone. But as luck has it, the person who interviewed me was on her way out, and I'm not sure that the managing partner knew that. But so I got a second chance, and did better on that second interview. At the same time, there was another firm in San Diego, which candidly, sounded pretty good to me, right? Being out in California. If you've been to San Diego, maybe some of you guys are from that part of the country, but it's a beautiful place. So I'm thinking, all right, I could learn to be out in Southern California. Anyway, so that fell through, and so I'm trying to scramble, because Edison had said to me, they said, we're interested in having you come join us, but we want you to work here with us as a consultant. And I'm thinking to myself, well, I don't really want to be a consultant. I want a job. And so I kind of poo-pooed that, and I'm like, yeah, all right, we'll see how it goes, thinking that I had the San Diego opportunity in the bag. So San Diego falls through, right? And I kind of am figuring out, what am I going to do? And it turns out that my mom had a friend whose husband was with a firm in Pennsylvania. And so I happened to mention this to her, and she's like, oh, well, you should go talk to this, the fellow who runs this firm. So nothing better to do, I did, and he suggested that I go to Philadelphia to a conference. So my point is that there was some networking that was going on there, and I didn't really understand what that's all about, and maybe you guys hopefully do, but there's a reason that expression, the cliche that is more who you know than what you know, is still around with us, because it's true. Anyway, so I went to a conference, and I happened to run into, actually I did it on purpose, the guy from Edison who was the managing partner, and we had a little bit of a conversation, just enough so that the following Monday, I showed up at his office here in Princeton or Lawrenceville, and at 9 o'clock, I'm like, all right, well, in a suit, I'm like, all right, here, I'm ready for work. And he's kind of like, what are you talking about? What are you doing here? He's like, look, by chance this associate has left, right? She's gone to another firm in California, we'll take you on, but just for one day. Let's see how it goes, right? So on a day-by-day basis. Anyway, so I guess where I'm going with this is that everybody has their own story. In my case, it was a brutal 6 months. Every day you got to go in there not knowing if they're going to say, all right, nice try, but it's not working out. Finally, 6 months later, in 1995, they said, okay, good, we like you, and we'll bring you in full time. So hopefully your process won't be as painful, because trust me, that was difficult. Any category into which you have interest in going is going to be competitive. I mean, look, you guys have gone through the process. You've gotten into Princeton, so you appreciate that. A zillion talented people, a zillion. Like I say, a lot of this is just luck. But a lot of it too is networking. And then to Shahram's question of how did this firm get started, so somewhere around 2000. So I'd been with Edison for about 6 years. There was a recognition that, because the venture industry, and we're going to look at this in the next slide or two, the venture industry was completely different today than it compared to 1994. So sometime around the year 2000, there was a recognition that there was a lot of early stage. In fact, I'm going to start calling out. I apologize, but I want to get some more engagement here. So, what does early stage company mean to you? What's the definition of early stage business?
I'd say either pre-revenue, still trying to find product market fit, small team generally, and either looking to raise early funds with high equity or bootstrapping.
Perfect. It's exactly right. So at the time, in the end of the 1990s, there was more capital for expansion stage companies, and so expansion stage in your mind, what's an expansion stage business? Yeah, I'm sorry. In the great sure, yeah.
The company's expanding.
Yeah, that's true. I mean, it seems silly, but that's true. If you're trying to expand from a marketing and sales perspective. So this fellow's point, if early stage means that you have, you're trying to still find your product market fit. You're just getting started, yeah. So expansion means that so now you've reached the point, maybe $1 million or so in revenue, right? And you're trying to accelerate your marketing and sales. So you go out and you raise money to hire sales and marketing. So that's exactly right. You want to expand in a more accelerated capacity. So the point is that in the 2000 time frame, there was a paucity of early stage capital, and also at that time in a market, from a market perspective, you had the Dow, which was and the Nasdaq were reaching all-time highs, and so there was capital available, and the internet boom was starting. So you had, I think, a recognition that there was an interest to fund these earlier stage opportunities. So bottom line is, I happened to be in the right place at the right time because from a networking perspective, I'd been around for 6 years. People knew who I was. And when there was a desire to launch this fund to fill a market need, I was one of the names that came to mind, right? And I knew some of the people that were interested to get it launched. So that's my story of how I kind of progressed from somebody who couldn't have spelled VC if you had given me the V, to eventually getting into the industry where I was in a situation where I could actually have a firm where I was one of the co-founders. Again. Better be lucky than good, but we did have success from an investment return perspective, and we'll talk about that. So as Shahram mentioned, I'm going to walk up here. I'm going to start calling out people. So again, apologies, but just make it more interactive. So our strategy is, in that blue there, right? So we're an early stage fund, right? And so what does that mean? Seed, Series A, Series B. So these questions get a little more difficult. So in your mind, difference between a Series A and a Series B, how would you answer that?
Number of rounds of funding.
Yep, true. Yep, absolutely. Series A typically might be the second round. The Series C could be the first. So what we're doing is, so if I'm starting a company, okay, and I come from Silicon Valley and I've got a great technology, but I need money because for the next 3 years I'm going to be unprofitable. Okay, so maybe initially I'll go to friends and family, right? You raise a few $100,000. Okay, and then you maybe in today's nomenclature you have the next step, okay, would be a seed financing. Okay, so seed financing is maybe a few $1 million, right? Back in '94 it was a couple $100,000, but it's evolved. And then, as you say, the Series A would be the next step in that. Okay, so you have, I've seen companies that go all the way to Series F. Okay, and then maybe you go public. Generally, you want to stay away from companies like that because you've got larger challenges, but that's a conversation for later in the semester. So that's our strategy, though. So we're coming in early. Okay, we're coming in, and I find it the most exciting time because then actually the entrepreneur will listen to you. Okay, we had 5 companies in our previous portfolio that today trade on NASDAQ or the New York Stock Exchange. And when you get to be 300 people, 400 people in the business, they don't, right? They've got people that are specialists, and they don't need to care about what the investors. But if there's 4 people, right, and you're one of 5, right, then your experience could be helpful. So that's our overview for us is we're an early stage venture fund, and we're participating in the first few rounds, the seed, the Series A, and the Series B. Questions, comments on that? And then just to kind of roll through this, so we're also, as Shahram mentioned, so hopefully you're going to get different speakers that can have different, right? Some are going to get focused on healthcare, maybe some are on energy, some are doing later stage. So our focus, we're a generalist, okay? And so if you're a specialist, the challenge, well, here, let me ask that as a question. So let's see, okay. So what do you think the challenge is if you're between a specialist versus a generalist, as an investor?
I would just assume that specialist is like somebody with a specific area of or a specific market that they usually invest in.
Yes, absolutely.
Everyone.
Yep, that's right. So specialist is focused on one category, and then the general. But what would you think are the challenges if you're a generalist like we are? Maybe what would your knee-jerk reaction be? It would be the hard part of trying to do things, trying to see a bunch of different companies, one day in materials, one day in energy, a third day in medical device. What would be the challenge that you think would come up with that? Yeah, sorry.
That you don't specifically know the ins and outs of the market.
Exactly. So what we do, so we've partnered with, so the reason that our firm is called Tech Council is because we partner with one of the largest technology councils in the United States. Thanks, sir. And so they touch 30,000 companies, and they've got experts in all these different areas. So to your point, we can turn to these experts when we have a question, whether, whatever is maybe real estate, right? If we're investing in a prop tech company, an insurance company, because the world's becoming more specialized, and you can't make investments unless you know what questions to ask, right? And to understand the questions. So we're a generalist. We're investing in companies that might be up to 15 million in revenue. Okay, so. And then we'll invest up to 3 million, let's say, into an initial round. All right. I mentioned the differentiators. We partner with one of the largest technology councils in the country. We also have an investor network. So what does that mean? In fact, here, let me ask. What's an investor network in your opinion?
Just different investors looking to invest in a company that
Yeah. So Shahram mentioned a limited partner, right? So a limited partner is someone who invests into our fund. So we have a fund, this one that's 55 million in size. Okay, it's got 150 limited partners. Okay, limited partners might mean someone who's hopefully like you guys in 25 years, you've gone out and you've created a company, you've sold it for $50 million, right? And now you've got capital to invest. Okay, that's a limited partner. So those guys generally have expertise, right? Maybe it's in the pharmaceutical category, maybe it's in software, whatever it might be. So anyway, so we rely on that network, on that limited partner network to, as we evaluate opportunities. And frankly, they also, Shahram mentioned too that the secret sauce for an investor, right? So there's some firms that have been around for decades, right? So Kleiner Perkins, you might have heard of Kleiner Perkins, Excel, who used to be here in Princeton, Sequoia, right? So these are firms that have been around a long time. They've got great brand recognition. And so they get deals from all over. So they're more likely to be able to choose a successful investment because they get the funnel from which they can select hopefully the best. So we use that limited partner network as well to funnel this opportunity. All right, so just one other thing that let me just comment on. I was going to try and ask a question, but there's really no logical question. But this one, I've said this before, right? Little luck never hurts. All right. So I'm going to pick up the pace a little bit here so changing market. So this look. So here, let me ask some questions here. So look, you got a bright red shirt. I got to ask you a question. I'm sorry. So as you think back, right, you think about some of the changes today compared to the last 10, 20, 25 years. I know you guys are all, 18, 19 years old, but what would be some of the things that you would expect to have been things that have changed within the market over the last cycle or two?
I don't know. I think internet and tech companies are way hotter. So like the SaaS model, for example, has been more popular. Those sorts of investments have been doing really well. So as a result, there's like more distributions these days than probably a couple decades ago. Things like that.
Yeah, good answer. Yep. So SaaS as a model has changed. So when I came into the industry, you had client-server technology. I said I worked at Oracle, right? You had minis back then with, so the whole computing architecture and technology has changed. That's absolutely true. So from a technology perspective, things have changed. From an economic, from a economy perspective, things have changed. From a globalization, right? Things. So, but just to be more specific, I guess, in terms of what's happened on the venture side. So when I came into the market, $2 million was a lot of money, right? And that's not the case anymore. I mean, I know in a relative way, right? For all of us individually, $2 million is a lot of money, but the industry has grown by almost 5 times, right? So now the venture market is $160 billion, right? So it's a big category. But let me just maybe again asking questions. So why? Let's see here, right? So why would you think that the corporate category has increased by almost 5 times just over the past 20 years? Because you see there that it says the corporate market, it's now 25% of the total venture industry. What would be some of the reasons that you think that's the case?
Maybe the investment has been consolidated into corporate companies more so than it has been like separate companies that are smaller.
Investment has consolidated into some of the bigger companies, so they're bigger. Is that the thought? Yeah. Some of the companies like an Amazon or Google, they got plenty of cash. Apple, that's a good example. Other thoughts? What would be another reason that corporates are more active?
Maybe it's actually to grow, more people saw the promise in it, and maybe they may bring other prestigious actually to the industry.
100%. Absolutely. They see, so for corporations, and we have, by the way, so among our limited partners, right, we have Bristol Myers Squibb, we have Celgene, we have Horizon, right? And so, to the point, these corporations are all trying to find innovation, right? They're all trying to find what's new because these corporations don't stick around forever, right? And so so there's a natural attraction between innovators and the big companies who are trying to find the next big thing. So right, so the reason that corporates have increased in part, for both of those reasons. They don't want to be on the sidelines, right? They need to be, making money, but more important, they need to be seeing novelty. So Atlantic Health System, Robert Wood Johnson and Barnabas, these are both major health systems in New Jersey that are investors in our fund, and the reason is because healthcare, to choose one category, is undergoing massive change. Right? So, the self, by the way, here's another change. You look at the difference between the 90s, right? You didn't have these, right? So there's technology that leads to investment opportunity. You've got regulatory change. So from a, kind of seeing what's going on. But, and I tell my children this all the time, that's opportunity, right? Because, yes, it's risk, but it's also opportunity. But bottom line is that if you look at what's happened over the last 25 years, okay, the category, the venture category has grown enormously. Okay, it's just grown enormously. You've got more entrants, you've got hedge funds, you have crowdfunding. By the way, I'm a big fan of crowdfunding. It kind of came on the scene like 10 years ago. Okay, Madame in the yellow shirt. Crowdfunding. Can you tell us what's crowdfunding?
I'm not exactly sure, but like maybe getting funding not just from specifically like high net worth individuals, but from larger groups.
Yeah. It's getting capital from a broader audience online, right? So historically, venture capital came from, like I said, these entrepreneurs that are successful, but I think that what the view is, hopefully, because raising capital is a very inefficient process. So crowdfunding is going to be a way that people, if you have a business and you're trying to get it launched, you can go online, you can get 30, this is an exaggeration, but you get smaller dollar amounts from people in a broader geographic area. And so I think that's going to, I'm hopeful that's going to have a big impact, but these things kind of go in waves, and so right now it's kind of out of favor. But anyway, so what are some of the changes? It's gotten a lot bigger. It's gotten a lot more pervasive into different categories, different geographies. And the other thing is that, so in 1994, right, mid-90s, when I was, if an entrepreneur would come into our office and say, here's the idea, and we'd listen to it and try and decide whether to invest, sometimes you'd say, yeah, this is a great idea, but maybe the valuation was too high, right? The price at which they wanted to attract capital. So what would you do if somebody said, here's my idea, and you said, yeah, great idea, and the person was someone, to Shahram's question earlier about the people part, right, the behavioral economics, so you had confidence that they could run a sound business, but the pricing was too high. And how would you respond to an entrepreneur like that? Yeah, that's right. Yeah, if you're the entrepreneur, I absolutely agree. You would go to other, that's exactly right. You would go to other sources of capital, and you would try and fund it another way. You're 100% right. But 30 years ago, you couldn't do that. So now you can. So it's a lot more difficult to, as Shahram mentioned, to be differentiated as an investor because you're negotiating leverage because there's so many more sources of capital. If you're an entrepreneur that you can go to. All right. So just to fit. So economic cycle. Right now, in today's climate, right, which was what you guys care about, right? So today's climate, it's been a bull market for 10 years. I don't know when the shoe's going to drop, but it's got to drop, right? Because things go in cycles. You're going to have up, you're going to have downs. So that's kind of the backdrop. And so I think today, right? So I've got a friend that Shahram probably knows, Zev Sherrill, and he left the market. He said, look, this is too hard a place to make money right now. Because it's been, the value of money has been commoditized. All right, comments or questions about, yeah, go ahead.
So I think in the internet boom when the bubble burst, or prior to that, there was a lot of venture capital funding. A lot of people started investing,
But when the bubble burst, a lot of venture capital pulled out. So when this new shoe does drop, what do you think that would eventually look like? Do you think that's going to be as drastic as it was around the early 2000s, or is this increase in venture capital funding overall sustainable?
Yeah. So first of all, does everybody hear the question? It's a great question. Yeah. All right. So the short answer is I don't know, right? And you can lose a lot of money kind of waiting for that shoe to drop. If you keep waiting for the markets to be where there's better bargains, right? Then you're not investing, right? And especially, by the way, so the other dynamic with these partners, so venture capital is done and I apologize for getting in maybe too over your heads here, but so venture partnerships are 10-year partnerships, right? So what that means that you, if you've got $1 million, right, and you say, all right, I'll give you $50,000, but I want $200,000 back at the end of that 10 years, right? So there's 10-year partnerships. So the bottom line is I got to get to work now, right, in years 2, 3, and 4 to put that $50,000 to work. So the question is, well, when the shoe drops, is there going to be, are people going to pull back? I mean, look, simplistically, absolutely, right? And that's why if you look at the corporate venture community, they've classically done that, right? They always kind of pulled back, when the when at the low water mark, and then they went in and they lost everything because their timing was bad. Whereas those that stay with it, right, over a more sustained period of time, are more likely to do well. So I guess the short answer is yes. I think that people you're going to, right? I mean, like in the 2010 timeframe, it was they called it a nuclear winter because you couldn't raise capital, right? You had to syndicate, you had to support these companies with others around the table because you couldn't bring in new money. So it's absolutely going to happen. But that said, you have enough contrarians, and you have so many different. We talked about you've got the hedge funds, you got the family offices, so you have different sources of capital, crowdfunding hopefully. So hopefully it'll mitigate. Hopefully it won't be as pronounced, I guess. So, all right. So, sorry. Yeah, go ahead.
So I believe you founded your firm after the dot-com bubble burst in the early 2000s.
Yeah.
Did that actually end up helping you kind of as a fledgling VC firm in the tech space because people were maybe a little bit more scared or skittish after seeing a result of kind of their hysteria in the late 90s?
Totally. So right now, for example, so it's all about catching the wave, right? If you're body surfing, you want to, right? And the same thing's true, right? So we were lucky that, to your point, that we invested in the 2003, 2007, whatever it was, and then the companies matured, and then the exit environment, right? The IPO market kind of picked back up in the 2013 trend. So you're 100% right. The other challenge is that right now, and this is to your advantage, right, for all of you guys, although maybe you're a little bit young, but recruiting market, it's really difficult if you're an employer, to bring in talented people, right? You got to pay them crazy amounts. So it's just hard to find the people to start with, right? And at the end of the day, these companies are all about, great people that are complementary that can work together. So, all right. So just, yeah. Sorry.
Just one.
Yeah.
On the last slide, I was just wondering if you could talk about the context of the last bullet point about the VC industry is not a place to make money.
Yeah. Yeah. Good question. Yeah. It's right. So why am I doing it? So I think, there's a little bit of, you guys may have heard of that, the guy, the patent office guy in 1899 that says, why do we still have a patent office? Because everything that's, worth patenting has already been patented, that kind of concept. So there's a little bit of that. I mean, look, the reality is to me that if I think about the climate today, right, as a place to make money, I've never seen, right, in 25 years, a comparable level of innovation, right? If you look at, because it's just a lot easier, right? We talked about the SaaS companies. So there's just there's gene therapy, robotics, AI, right? There's just a whole bunch of great, cool stuff that's changing materially society. But I think what Zev was alluding to was that, well, maybe he's better off, which is what he's doing, starting a business, right? Because he wants to be on this side, right, the supply demand, right? Because if you're and the number of companies, and I'm surprised to hear this, but Wayne Tamarelli reports that the number of startups keeps shrinking, in the U.S. So you want to be on the positive side of that. So if there's more money and fewer companies, I think that was what he was talking about. Yeah.
Just to follow up on that, earlier you mentioned that like money has been commoditized, or like that was part of the problem with money being commoditized. What do you mean by that?
It's just more people. They've all got money. I mean, if you have a bull market for 10 years, you have all these entrepreneurs that sell their company. They've got a lot of money, and if you're a new guy, and you say, "Oh, I'll take," and there's like 15 people that want to try and put money into your business, you're just going to increase the valuation. So the value of the money is comparatively less. Okay, so I want to touch on these case studies. So I'm going to try and zip through these things. But I mean, this is a kind of an obvious point. But if you don't have money, you can't invent. I know Shahram's going to spend time on this. But I just wanted to give you a little bit of sense of the process of raising a venture fund, right? So I will tell you that it's hard. It's hard. You got to get used to the word no. So for Edison, right? So Edison at the time, we approached 2,000 prospective investors, of which 15 said yes. And during that time, when we were going to market like that, our managing partner was the president of the venture industry in the U.S. We'd had 3 prior funds, each of which were like in the top, quartile, right? So they'd done extraordinarily well. And they had great brand. So, but look, everybody's got different reasons, right? Timing, they just, if you had $1 million to put to work, maybe you've got, somebody in the family who needs it for medical reasons, or maybe you're going to go buy a house, right? So there's just reasons that are independent of. So I think that's, when you hear the word no in your own career, which you're going to hear, I'm sure, a zillion times, you want to kind of appreciate that it's not necessarily what you're pitching. But anyway, without capital, there's no firm. But from a fundraising perspective, you want to think in concentric circles. What does that mean? It means that when I first started to raise money, who did I go to? I went to my boss, right? Because he knows who I was, right? Or I go to family, right? You go to people that you know that know you, right? Because they're a lot more likely. So I mentioned Edison, having 2,000 people. So we went. So as a junior person, I got sent to call on all the international companies. So I was in Finland, right, trying to raise money, right, and but I guess that's probably when I had that epiphany that really you're better off closer to home with people that are going to be knowing who you are, knowing your story, more comfortable, right? It's just harder the further out. So that's concentric circles. I mentioned the value of crowdfunding. There's no efficient way right now to raise money. You just have to kiss a lot of frogs. You have to knock on a lot of doors. Historically, the way that it works, and I know we asked about the commoditization of capital. Historically, what happens is a guy like Mark Andreessen, who I know Shahram and I know, but you guys probably all don't. But he was the guy that started Netscape, so he did very well. And then he started Andreessen Horowitz, right? So that's been historically how you do it. You become an entrepreneur, you make a lot of money, and then you start to invest. But there's also an alternative approach to get into the venture industry where you do an apprenticeship with a venture fund, or maybe you're an investment banker, and that leads, then your skill set is such that you can be valuable to a fund. So that's what I would say. Questions about raising a fund, the process? Yeah.
Yeah. So we were talking about cyclicality earlier, and obviously I imagine that given the risk profile of venture, like LPs would not want to put money into VC in the downturn. So how do you VC fund kind of approach fundraising and keeping the capital in a downturn like earlier?
Yeah. So everybody heard the question. How do you approach raising money in a downturn? Well, the reality is that you get a lot more funds launched during an upcycle, right? Number one. But like I said, so you also have some institutions that are in it for the long haul. number one. Number two, you have people that will back you because they know you, and hopefully that's a positive. And then you also have, as I say, you got different reasons. So I naively felt that people invested in a fund for return reasons, but that's only one of the reasons. What are some other reasons that you would think that investors will put money into a venture fund besides just the return?
I guess people like to see, new technologies that are able to change the world come into fruition.
Yeah, that's a good reason. What's another reason?
Also, maybe something that's already succeeded, just to put it out there, portfolio.
Yeah, a little bit of sharing in the upside of the visibility and the recognition. Absolutely, yeah.
Maybe you want to support certain issues.
Yeah, for sure.
Investment in researching certain medicines that might help someone that that is affected.
Yeah, that resonates for sure among people that have, say, a disease and they want, if you're targeting that, that's absolutely a reason. Other reasons that you might think that people would be putting money into a fund?
To possibly diversify their risk exposure.
Good answer. So another reason would be deal flow, right? So we had, for example, an investment bank. So John Martinson, my boss at Edison, he said, look, don't get discouraged when you reach out to these people to see if they want to invest and they don't return your calls. He said their phones only work one way. They can just receive calls. But we had approached CIBC Oppenheimer. It's one of the investment banks in Wall Street with Edison 4. And they were interested, right? A guy named Roby Blumenstein, but impossible to nail down. So I think I just ended up going. I was up in Hackensack. I don't know. He had a board meeting, so I just showed up after his board meeting and just kind of surprised to see you here, even though I was expecting him and hoping he's going to show up, but the reason that they invested is because they were looking for companies to take public, right? And so we, as a feeder, could provide that fodder for them. All right. So that's it. So this is an important slide, though, right? Because everybody thinks, investment is, it's fun. I get to kind of, kick back. And by the way, I had no idea. I think I shared, my impression of venture capital was it was a leisurely, right, and it's not that way. Not that way at all. But this is an important slide because the perception is that it's all about making the right choices, and and Shahram hopefully can reinforce that in my mind anyway, right? You really need to be right preparation and and obviously results. But this is a key thing. Without money, you have no company. You have no company. Okay. So I'm going to quickly touch on this and as a lead-in maybe to the case studies. By the way, yeah.
How have you seen valuation change over time? With the development of venture capital, have you seen valuation becoming more complex or data-centric?
Have valuations changed over time, and with data, have they become data-centric?
Yeah, the way you go about valuing companies compared to the 90s, how have you seen that change, I guess, with the rise of information and more data and just more knowledge about industries as a whole?
Well, so I would say that, again, it's a supply-demand, right? So if you have more supply of capital, valuation is going to go up, right? Because people have more choices. But to your point, there's greater transparency for the entrepreneur, right? And you don't want to invest in a dumb entrepreneur, right? You're going to lose all your money. But if they're smart, then what they do is they come to the negotiating table armed with, okay, here's the 5 companies that are examples of why this ludicrous valuation makes sense, right? And then, of course, it's incumbent on you to go right and have that conversation. But you're right, having that information, that transparency, I think, but that transparency absolutely changes the discussion.
Yeah, so just going back to the previous slide, I feel like some of the big names you mentioned, like Korea, they have much better, for a newly founded VC companies compared to all these big names, they have more attractive returns, they have very good deal flows, and for investors, especially very rich investors, what would be the incentive for them to choose a newly founded startup, like a VC startup, compared to a big name?
Well, so number one, they can't get in, right? If you're Sequoia, you have investors that have supported you since the beginning, and you're going to be loyal to them, right? And you can't. So our model, so we're we have 130 million under management for 2 funds, right? So you could say, all right, well, you've been successful. Why don't you have a larger fund size? Because we have a certain model. We invest only 2 million, right? And we're targeting the region, and we're only going to have 20 companies. So you can't go out and raise 500 million unless you're going to change your strategy. So Sequoia, it's not going to change their strategy. So they're going to stay with the investors that supported them early on. And then again, also, if let's just say I know you, right? And I say, wow, he's a smart guy, right? I just think highly of him. So then you're going to come to me and you can say, I've got this, here's my strategy. I say, yeah, that makes sense. Count me in. So there's that dynamic that happens, right? But look, it's if you have brand, it's like anything else. It's easier, but there's no guarantee of success. There's too many variables that influence an outcome. So I want to get to that actually, because I want to talk about the case studies. So KidBiz and Instamed. So just by a show of hands, who would put their money into this first one, KidBiz? Okay, 1. Okay, and by show of hands, who would put their money into this health technology company called Instamed? There's a pretty conservative group here. All right, we got 1. Okay, well, let's talk through them and see what the facts. And by the way, I don't want to be presumptuous, but hopefully people had a chance to read these write-ups in advance. Yeah, good. All right, all right, let's start off with KidBiz. So, all right, so in the purple sweater there. So what's the premise for the business? No, okay, no worries. Someone else have the sense of what the what's the yeah, good.
So it's an ed tech company.
Yeah.
And they deliver sort of like good-to-go services to schools.
Yeah. Yeah, exactly. So again, this is the year 2000, right? So this is a different climate. So this is an older one, but and just maybe being wearing your positive hat. So what would be the reason that you would want to put money into KidBiz if you were a bull on this one? What would be a reason that you would want to put money into it? No, that's right. If you feel comfortable, you felt comfortable in the internet, absolutely. Yeah, absolutely. 100%. That's exactly right. Yep. If you felt that there could be greater connectivity, and that you wanted disruption in the educational process. So if you were going to be a bear on this, let's see here. That with the pink water thing here. If you're going to be a bear on this, why would you say no? Don't put money into this one.
Maybe I don't understand the internet enough.
If you don't understand, okay.
I don't have enough experience in schools to really understand.
It's a good reason. It's a good reason. And I got to tell you, that happens as a generalist, right? You're getting all these different businesses coming in, and that's absolutely real. It's absolutely real. Absolutely real. Yeah.
You did mention that the education market starts to penetrate, and I was wondering if you could focus on that how does it determine that?
Absolutely. So I'm sorry. How we determined that the
education market is hard to penetrate?
Oh, okay. Well, so I think the challenge with education, there's a few issues. So one is that it's dependent upon government, on the public sector, right? So you need state money and you need federal money, and it kind of comes and goes depending on the administration. And I think so we live in Lawrenceville, and I want to say that the budget is like 55. I probably added maybe it's like 70, but it's a fixed amount, right? So 70 million, and 2/3 of that is for the teachers, is for the people. So how much is really left when you're talking about the technology, which is what this qualifies for? And then you've got different vendors that are calling on the same person, right? And if somebody mentioned the importance of brand, and brand for an entrepreneur is a big deal. If you're a customer, you don't want to put your neck on the line for an unknown unless there's a real reason, right? So those are some reasons. I mean, maybe Shahram has some better suggestions, but yeah. So education, and the other thing, just parenthetically, is that education, has not been a category where, like, if you think about the big winners, right? And I know this is more recent, but you have Google, you have Amazon, Microsoft. You don't think of an ed tech company, right? So it hasn't been. So you have to think about, as an investor, you have to think about not just kind of the ingredients for the business, but you have to think about how much capital is it going to consume, right? And then ultimately, who's going to buy it, right? Because 90% of these deals, and I know today you have a more robust exit market. You have SPACs and you have IPOs and things. But generally speaking, you're looking for a trade sale, right? And so you say, well, what's the exit multiple going to be for an education company? Historically, it hasn't been that great, right? And you also want to look and you say, well, what are some other companies that have done well entrepreneurially, right, in education? And there haven't been as many. So those are all some of the issues that, to your question, in addition to the challenge from a sales cycle perspective. From a sales cycle perspective, so let's see. From a sales cycle perspective, what do you think would be some of the challenges? If you're a salesperson for this ed tech company, what are some of the issues that you're going to get, right? If you're trying to sell this, you're knocking on the door of a school district, right? What are some of the things they're going to tell you, do you think?
Well, I don't know. I think from a sales perspective, like, you might really just be able to sell to them once, and then there's not really like a repeated sale that you can give them.
Yep.
Maybe it's something that they could like renew a subscription to it, but still you have like a very limited group of people that you're selling to.
Yeah, it's a fair point. Yeah.
I think they might already have something in place that fulfills a similar role, and so you have to convince them to switch to.
Yep, switching costs, absolutely. Yep, good point. Yep.
I think there also might be a lack of knowledge about the technology, especially at that time period, so people might be hesitant to change or hesitant to adopt them.
Absolutely, because you could purchase it, and these aren't inexpensive. They're $300,000, and if you do it, then you're kind of left in the lurch. Yeah.
There could be like data privacy issues, and issues regarding like how the technology is being used in the school.
Privacy, yep. Yeah, sorry, go ahead.
Yeah, I think for a lot of public schools, they probably can't act as like layers, and so as a result, the sales cycle is pretty long because they can't really make decisions.
Yeah, good point. Yep, it's bureaucratic. I'm sorry, I'm going to keep moving. I apologize, just because we have, I want to get to another company or two. But yeah, so look, so bottom line for this one, I think everything that you're talking about is true. But just to kind of get to the gist, so, and by the way, the other reality about partnerships is that you're not going to get unanimity, because you guys are all going to see things differently, right? And there's what, 70 people or 50 people, right? And the same thing's true with partnerships. So of the, whatever it was, 3 or 4 or 5 people that were voting on this, there was not unanimity. And the projection was to get to, I think it was a 3x or 4 times, meaning that if we put in, I think we put in $750,000. So we ended up in total putting in $2 million and getting back $70 million. They were acquired by a private equity firm for about $300 million. They grew dramatically. They had huge profit. But, did we see it coming? Absolutely not. The management team, did not have that type of pedigree. I mean, I know some firms, some venture funds that will say, we only invest in CEO or management teams or CEOs. I'm not sure what BioAdvance, but that have had success because they don't want to pay for somebody to learn on the job. And this was the opposite of that, right? These guys did not have prior success. But I'll tell you this: so entrepreneurs as a category are just wonderful to work with because they're driven, they're passionate, they're smart, right? You're not going to invest in someone you don't think has all those skills. So they're wonderful to work with. But even among that kind of self-selecting group, the CEO of this company was a woman. She was even a level above. Like on July 4th, right? My partner saw her on the beach with one of her biggest clients, entertaining. So she was 24/7. All right. So the next company is called Instamed, and I think we had one. By the way, just a little bit of context. So I think there was one person who said that they would have supported KidBiz, right? So, and here's another adage that I share, which is without risk, if you don't incur risk, you can't make progress. Okay, so the flip side of the coin of risk is opportunity. And so yes, these are all risky initiatives, but in order to make progress, you gotta support, right? You gotta put yourself out there, and that's true in all different endeavors, not just business. So Instamed. All right. So let's see. What you want to tell us what Instamed does or what their business is? No. Okay.
It's like a healthcare payment.
Yeah. Health payments. Yep. Exactly. Health payments. So this company, by contrast, so we got involved when this company was pre-revenue. Yeah, they're pre. So normally, we try and get involved. So that whole conversation about Series Seed and Series A, right? So normally we try and get involved with companies where their product is already developed and they've got some customers, because it's a valley of death, right? You're waiting for the product to be developed, to be commercialized, and it always takes longer. It always costs more money. So in this case, though, we did make the investment before the product was ready to be sold. So what were the things maybe that you either liked or didn't like about this one?
I thought it was incredibly complex to do.
Yes. Yeah.
Different parties that were involved, but I thought the main downside was the lack of incentive on the part of the insurance companies that would be processing this.
It's interesting. Great point. Great point. By the way, the CEO of this company, who is now an investor in our next fund, was kind of that way. I kind of laugh when you say that, because he could take anything any kind of subject or topic and make it complicated. Your head be spinning, right? So he had that ability to do that. But that's an interesting point. So they had a variety. So you're spot on, by the way. They had a variety of constituents, right? They had the insurance companies. They sold to the hospitals. They had ultimately the patients. That's what they were trying to get to. So I think that's a good observation. So what would be a reason to all the way in the back there, young man, the blue shirt. What would be a reason that you would want to invest in this? Why would you put money in?
Well, I guess firstly that it revolutionizes the way that the healthcare system would, again, so different product to always its competitors. I guess how it stands out.
Yeah.
For one reason.
Yeah. It changes. It makes, look, the whole health, I'm sure you guys have all seen that the whole healthcare process, when you go and you see a doctor or you go to the hospital, it's a very inefficient process with all the paper. So this company was just kind of getting in, so you're right, it automates and makes more efficient. Yep, that's, any other, yeah, good.
I think the value proposition for the doctors was pretty strong, because I think the figure was you could lose $25 on a particular claim and then only have to pay $50 a month for it. So if you have at least 2 claims that kind of are faulty each month, you're getting your money back.
Yeah.
And I'm sure they process thousands a month if you're part of a even small group.
Yep, good point. It's a good point. Other thoughts or observations yet?
Yeah, as far as not investing, I would say that the insurance industry it's a very kind of political topic that's subject to the whims of regulation and kind of huge law kind of upheaval, depending on what's happening in Washington. So I would shy away from a company directly tied to a kind of insurance claims process when the kind of legal standing of that could be totally different in a few years.
Good point. It's a good point. And we sweated it out. Every time there was a new presidential campaign, we sweated it out, because to your point, it can change. Good.
A reason to invest would be that the team seemed quite experienced in similar roles across a variety of companies.
Yep.
So even though they didn't know a product yet, because of that experience, it was safer than just being blind.
Yeah, that's true. That was a factor for sure. By the way, we invested in a common stock. I think this is one of the only deals that we invested in our portfolio that was a common stock deal. So preferred stock, I'm sure Shahram will get into this, but a preferred stock gives you rights and privileges. You can join the board, you get a dividend. If the company goes under, you have a first cut from a debt perspective. We didn't do that, right? So we invested in a common stock for this deal. And actually, it worked out pretty well because I felt there was more unanimity among the shareholders, right? Because you didn't have that thought of, well, these guys are going to get their piece if the company's only acquired for 10 million, right? So everybody's kind of on the same page. I kind of like that. And just two other points. I'm going to have to get going. I apologize, but two other points. One is that this company was interesting because they almost sold everything indirect. So they sold through banks, right? Believe it or not. So you say, well, why does that make sense? Because the banks would call on the hospital systems, right? And they got leverage. Because if you were having to sell this, and I forget the thought was, yeah, if it's $20 or $40 per claim, right? It's a difficult way to get scale, right? Because these guys ultimately reached 75 million in revenue and were acquired for almost $600 million. To get that kind of scale, right, to your point, you've got to get partners to accomplish that. So that was one decision they made that was the right choice, right, from a distribution perspective. And then the second thing I would say is that the CEO was a master at partnering, right? And so to get that kind of leverage. And so it wasn't just on the distribution side through the banks, but he also, for example, with a MasterCard, right? Fiserv, right? So he was wonderful at rising above the noise, at partnering, and also raising capital. He ultimately, raised about $50 million. So the return on this one was an 8 times return. We put in ultimately $5 million and got $40 million back. Now, of course, I will tell you that this is biased because I'm not going to stand up here and tell you about all the money that we lost. But anyway, it's been a pleasure. Thanks so much.